Welcome to Steve Savant's Money, the name of the game. Hi everyone, I'm your host, Steve Savant, syndicated financial columnist and money gamer extraordinaire. Today we're talking about lifetime income you cannot live, and we're talking with nationally recognized annuity expert, Mike McGlothlin. Mike, welcome to the show.
Great to be here.
Mike, the number one risk in retirement is living too long. And everybody's now, and I think it's a justifiable and warranted fear that we're going to be short on our retirement money. I don't know of any other product, whether it's security or non-security, that can guarantee a lifetime payout that you cannot live. And a lot of people are looking at this product line as kind of the underpinning of their foundation because we're going to have fixed expenses. And those fixed expenses in retirement are going to go up because of inflation. So we need to be able to package together products that'll at least address the floor or the basic domestic expenses that I'm going to have in retirement. And I think seniors are really aware of this, and we're baby boomers and we're totally awake to this idea right now. Why don't you walk me through some of the basics of lifetime income? How do they do that?
Well, I think you hit the nail on the head. First of all, there was a recent study done, and the number one fear of Americans above dying in a plane crash and public speaking is outliving your income. So it is a hot topic. And I think there are a couple different ways that carriers that you really need to take a look at of how they're doing it. First of all, what does their investment portfolio look like? Are they matching their liabilities with their assets? That's one thing from a financial strength standpoint, and just good credit quality in terms of making sure.
So ratings are important to you?
Ratings are important, but also drilling down into what's the quality of that bond portfolio. Because if you're locking into lifetime income, your life expectancy may be 25, 30, 40 years. You need to make sure that those assets are backing that liability that the insurance company has taken on. The other thing that is largely unspoken in the insurance industry is longevity credits. Pulling your money just like you would on a life insurance policy, being able to pull that on the deaccumulation side really helps you out so that you get some of the mortality credits as you live longer.
Now, you used the word just now, deaccumulation. I think most of our consumers understand the word accumulation, whereas we're accumulating money. And with annuities, if they're, and I'm speaking specifically in non-qualified, they accumulate tax deferred. And that power of not having to pay taxes every year is quite substantial over a long period of time.
Absolutely. You can make a huge difference in your accumulation pool. And when you're taking a look at retirement income planning, you want to build up a nest egg that you can live off of. And the quicker that you can build that up through tax efficiency by not paying tax each and every year, the better off that you're going to be. The other advantage of using a lifetime income on the back end during accumulation is that you get to use both tax deferred part as well as the already taxable portion. So the money that you're taking out through a single premium immediate annuity is both a combination of tax deferred and already pre-tax money.
So I'm actually getting my basis back, and I don't have to wait till the end game now. I thought the old rules used to be, last in, first out, but annuities seem to have a kind of a special exclusion.
Absolutely. But that's one of the things with income riders, one of the negatives to income riders, because they are last in, first out. Whereas with a traditional single premium immediate annuity, you get to get that exclusion ratio, which can be as high as 85% in a lot of cases.
So when we're talking about distributions during retirement, your phrase, deaccumulation, that takes on a whole new understanding for consumers. And you just brought up a big point. I think it's not all these products that are annuities that are giving lifetime distributions aren't created equal. I just heard you say there's a difference between SPIA, single premium median annuity payouts, and you said like a rider on a contract, an income rider, just on the tax issue alone.
Absolutely, yes. They will still provide lifetime income, but the other thing is one of the cruelest taxes of all is inflation. And the ability to put your single premium immediate annuity with a 3% to a 5% cost of living increase guaranteed, that's a huge benefit that we don't talk about enough.
Now, I've noticed that when you do that, and I was just on one of the great software support systems for advisors called Canix, I noticed that when you do put on a COLA rider to take on the CPI or inflation, I noticed that the actual income goes down a little bit at the front end, but that continuation, that climb every year, are most of those simple, or is that compounded on ones you've seen?
You're basically compounding on top of one year right after the other. It's a nice option for clients. We have one income rider that does that, but just about every SPIA, single premium immediate, would have some type of option like that. It's something that we don't talk about in the industry enough, especially with long life expectancies. That cost of that inflation, those consumable goods, they're going to go up. Our income needs to keep pace with that as well.
So if we could match a single premium immediate annuity with a cost of living adjustment rider, that would actually go up every year 3%. And if I'm understanding you correct, even if I become the Guinness Book of World Records, she's Jean Clement. She lived 122 years, 164 days. If we lived out that far, hard to believe, but if we did, they'd pay that payment.
Still paying it, guaranteed.
See, this is why we're looking at these floor products to undergird our retirement for the fixed domestic expenses. We come back, we're going to break out some of these products for you and give you a little understanding right after the break.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life from one of the largest distributors of indexed universal life, Ash Brokerage.
Well, welcome back to our second segment. Of course, we're with Mike McGlothlin, an annuity expert and a retirement expert. Well, let's talk about, we already mentioned single premium immediate annuities. This is a lifetime payout you cannot live. You even get part of your basis, your original contribution that comes back to you tax-free up front. Kind of a blending of gain and basis. But Mike, what about these new ones? This is not a new product, but it's becoming revolutionary from our standpoint because we haven't used it in so long, and it's called deferred income annuities, DIAs. What is that? What's the difference between that and a SPIA?
Well, first of all, it's one of the fastest growing segments of the annuity marketplace. I think New York Life has typically owned that marketplace for a while, but we've had 3 or 4 other carriers enter the market in the last 18 months. It's a great concept with a lot of flexibility for clients. You basically annuitize your contract of your deposit as soon as you make that decision. It's an irrevocable decision for the most part. However, it's a great planning tool with flexibility so that if you're concerned about outliving your income and you have some large assets under management that you feel that you can live off of for 15, 20 years, you can stick that deferred immediate annuity right at the end of life expectancy so that you know that if you happen to run out of money, you're still going to have that deferred immediate annuity. And from a financial planning standpoint, what the difficult part is when you run Monte Carlo analysis or whatever back testing that you do, you can't plug in infinity for your life expectancy. But if you have a set period of time, 15 years or 20 years, you can get with greater certainty that that money's not going to run out. Therefore, you could do a 20-year investment plan, have reasonable certainty that that money is going to last for that period, and then you have the protection of the DIA behind it.
So you're buying it up front and holding it for 15, 20 years in your example.
Exactly. You create the most amount of leverage that way.
Now, isn't it true? I think there's a difference in like a SPIA can hold up to a year, but no longer than. You can buy a SPIA, hold a year. Typically, a DIA is almost the opposite. You got to hold it at least 1 year, right? And then farther out.
Yeah.
So you could be shopping for blocks of income to support your floor, as I mentioned, your floor, your financial commitment for your living expenses and so forth. You could do that. You could use, so if you think you need to delay it, like you said, hey, I have enough securities to kind of handle. I think I can do that even in a conservative portfolio. I might be able to go 10, 15 years. I could delay my deferred annuity that long, and then it comes online right about, I probably like to give myself a little grace period, right where it comes online. So I'm always having income coming in my door.
Absolutely. We're seeing this used with even younger people that really, we're seeing the pendulum shift back from that, I want the maximum rate of return inside the 401k plans. We're seeing it go back to kind of the pension mentality. So that we're seeing a lot of rollover dollars go in there and turning this thing on at age 65 for a 45-year-old person, wait 20 years, and at age 65, I know that I've got that guaranteed income. And you can also opt for inflation protection on that as well.
Now, you just brought up another question for me here. You just use pension, which is qualified money. It's my understanding, even if it's my annuity, and if I'm married, that my wife and I can have a joint annuity on that contract, even though it's under my name.
Correct.
Isn't that so?
Absolutely.
And that means that doesn't matter what, both of us are going to get lifetime income, doesn't matter who survives.
Absolutely.
Well, I think that's a huge issue. Do you see a lot of people looking at that in qualified money now?
Yeah, I think that there's a lot of planning opportunities. When you have blended families, there's a lot of different ways to go. And also there's an issue of rebalancing assets when it comes to maybe a high wage earner versus a stay-at-home spouse. So there's a lot of different ways, but we see the flexibility of joint annuitants coming into play, especially with income riders and also with the DIAs as well.
Is there any difference between the income we're getting off single premium immediate annuities or deferred income annuities and GLWB riders, these guaranteed life withdrawal benefit riders? Any difference there?
Yeah, we see a significant amount because with SPIAs, you're using both principal and interest. If you were a 65-year-old person using the GLWB, you're probably going to get about a 4.5% to 5% payout, depending upon which contract that you're choosing. If you run a 65-year-old just taking income immediately, you can probably reasonably expect about a 6.5% payout of your premium. Then when you defer that for 10, 15, or 20 years, we've seen big jumps in the payout. You would have to have an income value on a VA or a fixed indexed income rider grow at 300 times the deposit in order to equal the same payout that you would on a DIA after a 15 or 20 year holding period.
So it really makes a difference to shop this.
Absolutely.
So you're not just shopping lifetime annuity in the generic, you're shopping, is it SPIA, single premium immediate? Is it deferred income? Is it GLWB riders? All this matters.
Absolutely. And if you're committed, if your client is committed to income, then an income annuity is probably the better tool. If your client is committed to accumulation, tax-deferred growth, then maybe a variable annuity or a fixed indexed annuity is better. And then that rider just becomes the what-if protection.
In your experience, seeing where the market's going, if we have any uptick of interest rates, what's this going to look like?
Oh, this will be huge because the investment portfolios of these companies long-term, they're already getting higher rates of return because they can be longer out into the yield curve. So any tick in interest rates could be really beneficial for this type of product.
Well, that's all the time we have for our show today. I want to thank Mike McGlothlin for being my special guest and today's money mentor. And before moving forward with any ideas on our show, always consult your tax advisor or legal counsel. And remember, as the good Reverend John Wesley once said, make all you can, save all you can, give all you can. I'm Steve Savant. We'll see you next week.